Hey everyone, and welcome back to the channel. Today, we're diving into one of the most crucial, yet often overlooked, aspects of trading and investing: protecting your capital. It's not about finding that one magical stock that goes to the moon. It's about staying in the game long enough to let your strategy work. That, my friends, is the power of risk management. Think of it this way: a professional race car driver doesn't just focus on the accelerator. They're masters of the brakes, experts at navigating turns, and they always wear a helmet. Risk management is your financial helmet and braking system. Without it, you're just gambling, and the house always wins eventually. So, if you're serious about growing your account and not just taking a trip to the financial casino, stick around. We're about to build your armor. The first and most fundamental rule is the 1% rule. It's simple, powerful, and non-negotiable for serious traders. This rule states that you should never risk more than 1% of your total trading capital on a single trade. Let's break that down. If you have a $10,000 account, the maximum you should be prepared to lose on any one position is $100. If your account is $1,000, your max risk is just $10 per trade. Why is this so powerful? It's all about emotional control and survivability. When you risk only 1%, a single losing trade is just a small setback, a normal part of the business. It doesn't trigger panic or the urge to revenge trade to win it all back immediately. It allows you to endure a string of losses, which will happen to every single trader, without blowing up your account. Imagine having 10 losses in a row. With the 1% rule, you've only lost 10% of your capital. You can still recover. If you were risking 10% per trade, you'd be completely wiped out. This rule is your shield against catastrophic failure. Now, you might be thinking, how do I even calculate my position size to risk only 1%? This is where the stop loss comes in, our next essential tool. A stop loss is a preset order you place with your broker to sell a security when it reaches a certain price. It's your automatic eject button that gets you out of a losing trade before the damage gets too severe. You decide before you enter the trade how much you're willing to lose. Let's combine this with the 1% rule. Say you have that $10,000 account, so your max risk is $100. You want to buy a stock that is currently trading at $50. Based on your analysis, maybe a support level or a technical indicator, you decide that if the stock drops to $48, your trade idea is proven wrong, and you want out. That $2 difference, from $50 to $48, is your risk per share. To figure out your position size, you simply divide your total allowed risk, $100, by your risk per share to dollars. 100 divided by 2 is 50. So, you would buy 50 shares of that stock. If the price drops to your stop loss at $48, your 50 shares will be sold, and you'll realize a loss of $100, exactly 1% of your account. You've perfectly controlled your risk. This calculation is the bedrock of professional trading. You don't just randomly buy 100 shares of something. Your position size is determined by your risk, not by a gut feeling. Next up, let's talk about the risk-reward ratio. Simply managing your downside is only half the battle. You also need to ensure your potential winners are big enough to make the risks worthwhile. A risk-reward ratio compares the potential profit of a trade to its potential loss. For example, if you risk that $100 on a trade, your stop loss, but your target price suggests you could make $300 your take profit, you have a risk-reward ratio of 1-to-3. Why is this so important? Because nobody wins all the time. Even the best traders might only be right 50% or 60% of the time. Let's say you have a 1-to risk-reward ratio and you rewrite on half of your trades. Over 10 trades, you lose 5, costing you $500, 5x $100. But you win 5, earning you $1,000, 5x $200. Your net profit is $500. C. You were only right half the time, but because your winners were bigger than your losers, you came out ahead. As a general rule, you should avoid any trade where the potential reward is at least twice the potential risk. A 1-to-1 ratio is a coin flip, and with commissions and slippage, it's a losing game over time. Aiming for 1-to-2, 1-to-3, or even higher ensures that your winning trades will more than cover your losing ones, which is the mathematical edge that leads to long-term profitability. Another powerful technique is portfolio diversification. You've heard the old saying, "Don't put all your eggs in one basket." This is that principle in action. Diversification means spreading your capital across different assets, sectors, or even strategies that are not closely correlated. For example, instead of putting all your money into 5 different tech stocks, you might invest in some tech, some healthcare, some industrial stocks, and maybe even some bonds or commodities. The logic here is that it is unlikely for all these different sectors to perform poorly at the exact same time. If the tech sector takes a hit, your healthcare or energy holdings might be doing just fine, cushioning the blow to your overall portfolio. This smooths out your returns and reduces what we call concentration risk, the risk of having too much capital tied to the fate of a single company or industry. For traders, diversification can also mean trading different, uncorrelated currency pairs in Forex, or using multiple, independent strategies. Maybe one strategy is trend following, and another is mean reversion. When the market is trending, one strategy shines. When it's range-bound, the other takes over. This multifaceted approach creates a more robust and stable equity curve over time, protecting you from the inevitable periods when one particular strategy is out of sync with market conditions. Finally, let's talk about one of the most important, yet most difficult, risk management tools, your own psychology. You can have all the rules and calculations in the world, but they are useless if you don't have the discipline to follow them. Fear and greed are the two great enemies of a trader. Greed makes you take on too much risk, chase trades, or refuse to take profits, hoping for more. Fear makes you cut winning trades too early, or hesitate to take a valid setup after a few losses. The solution is to create a detailed trading plan and treat it as your contract with yourself. Your plan should define everything: what markets you'll trade, what your setup criteria are, how you'll manage risk with the 1% rule and stop losses, and what your risk-reward objectives are. Write it down. Review it daily. Then, your job is not to make money. Your job is to execute your plan flawlessly. By shifting your focus from the outcome profit loss to the process executing your plan, you remove emotion from the equation. A loss isn't a personal failure. It's an expected part of the process, as long as you followed your rules. A win ain't a reason to get arrogant. It's simply the positive result of good execution. Mastering your psychology, the final piece of the puzzle that turns an amateur into a professional. It is the ultimate form of risk management because you are managing the single biggest risk in your trading, yourself. So let's recap the cornerstones of protecting your capital. First, always obey the 1% rule to survive losing streaks. Second, use a stop loss on every single trade to define your risk upfront. Third, only take trades with a favorable risk-reward ratio, ideally 1-to-2 or better. Fourth, diversify your investments to avoid putting all your eggs in one basket. And finally, master your own psychology by creating and sticking to a trading plan, no matter what. These aren't just suggestions. They are the pillars that support a long and successful trading or investing career. Implementing them will fundamentally change the way you approach the markets, transforming you from a gambler into a calculated risk manager. Thank you so much for watching. If you found this video helpful, please give it a thumbs up. It really helps the channel grow. And if you want more content to help you become a smarter, more disciplined trader, Be sure to hit that subscribe button and ring the bell so you don't miss our next video. Stay safe and trade smart.